So when we're looking at influences on financial management, you can source funds from two different areas, internally or externally. And within externally, you can look at debt or equity options. And this video is going to be focusing on equity as an option for businesses to acquire funds. But what actually is equity? The best part about equity is that the business isn't actually acquiring any debt. They're not going into debt at all. Instead, they are sourcing money by actually selling part of the ownership of the company to potential investors and rewarding them instead of paying them back like you would in debt, but rewarding them with small amounts of profits that the company makes in the future. And equity can be sourced privately or publicly, and essentially the main difference about which one you will choose will be determined by whether your company structure is a private company or a public company. When looking at public equity, that is for public companies only. And a public company is someone who is a company that is listed on the ASX or the Australian Securities Exchange. There are other securities exchanges in different countries. In America, there's the New York Stock Exchange, but in Australia, we sell company shares through the Australian Securities Exchange. The main way to know whether a company is public is that it'll have this LTD after the name. What that actually stands for is liability associated with that. But that's not the purpose of this area. We're more focusing on ordinary shares. So essentially, by issuing ordinary shares, a public company can issue part ownership to any member of the public. That is what they're doing when they're releasing ordinary shares. But there are different types of ordinary shares that people can buy through the stock exchange. This includes new issues, rights issues, placements, and share purchase plans. And these are the four that are within the syllabus that we'll be looking at. When looking at new issues, this is the first time that the company will issue shares on the stock exchange. And this is done on the primary market. In order to issue shares, a prospectus has to be issued, which we've looked at before. Essentially, it's a document that sort of outlines what is the business using the money for, what are the financials of the business, what will you get as an investor in the business. It's something that actually takes a lot of time, energy, and effort and requires a lot of resources to issue the prospectus. So it's not an easy thing to do. So to actually issue shares on the primary market, this process of issuing a prospectus is actually quite timely. It's one of the disadvantages of selling new. Holders will receive dividends from these new issues as well. And in this image here, you can see IPO. IPO stands for Initial Public Offering. This is for the very, very first time that a business will sell shares on the primary market. After they sell shares for the first time, a business might want to generate another $100 million and issue shares again. They'll just be called new issues, not the initial public offering. The IPO is the very first time that that happens. When we're looking at new issues, it's important to know the difference between the primary and the secondary market on the stock exchange. The only section of the stock exchange that the business actually benefits is this primary market here. This is where the business, in this case it's XYZ Incorporated, gives the shares to the investor, and the investor gives the money directly to the business. That is the only section that we are looking at under equity financing. In the secondary market, investors can trade, buy and sell shares on a daily basis, but that money just goes in between investors, not to the actual business. So this section we don't really care about as much. We are more focused on the business acquiring funds, and this is done through the primary market. So some case studies for you. When we're looking at McDonald's, they floated their company on the New York Stock Exchange in 1965. Since then, they have issued 1,660 million shares. So they didn't all do this the first time. They've issued them initially with an IPO, and then since then they would have made more new issues of shares, totaling 1,660 million. By the end of 2018, only 767 million shares were still on the market that people could trade. They actually bought back 893 million of those shares, and they are now owned by McDonald's by themselves. And they're actually working towards buying back more shares from their shareholders. In terms of Apple, they launched their initial public offering at $22 per share. And that was in 1980s, and they sold $4.6 million shares. By late 2018, we could see that the price of that had risen dramatically to $22 per share. So lots and lots of companies, very well-known companies, often issue shares on the stock markets. Now, a different type of share that a public company can use if they want to access greater funds could be through a rights issue. Now, this is when you only offer shares to existing shareholders at a special price, and that's in proportion to what they obviously own currently. The shareholder doesn't have to actually take up the rights issue. There's no obligation. They can reject it. They can maybe transfer it to someone else, or they can sell those shares if they want. But the benefit of why a business would do this is because if they've outlined in the initial prospectus that there was rights issues potentially coming up, they don't actually have to rewrite a prospectus. And like I said before, a prospectus actually takes a lot of time to create. So this saves time and resources. So instead of just creating new shares and going through the whole process of that, they can look to normal existing shareholders. It also helps them to create a relationship between them and their shareholders by giving them some sort of discount for being owners in the company, and also they're saving time. When we look at placements of shares, this is when public companies can offer additional shares to specific institutions and specific investors. So with a rights issue that we looked at before, they have to offer it to every shareholder. They can't pick and choose. But placements is for specific institutions and specific investors who they know have the funds to quickly buy more shares in the company. They can raise up to 15% of the business's current capital base with a placement. Now, the benefit of this is that they don't have to issue a prospectus, which, as we stated before, is cost-effective, time-effective. They also don't need to get general shareholder approval to issue more of these shares. So it's a really quick method for generating funds. And sometimes businesses need to access funds very quickly, especially if they're engaging in takeovers or acquisitions. They need to get funds quite quickly. So a placement is often one way that they can do this. Another way that they can do this for the same purpose is through share purchase plans. And this is when the company can offer up to $15,000 in new shares to every existing shareholder at a discounted price. Once again, they don't need to issue a prospectus. The price has to be below the current share price. If it wasn't below, then there would be no reason why shareholders would take on those shares. They would just buy them off the normal secondary market at a cheaper rate. They do have to get permission from ASIC, who is the Australian Securities and Investment Commission. They regulate the whole stock exchange, but it is relatively inexpensive and quick. And for that reason, when companies need to access funds quickly, this is another way to go. So placements and share purchase plans are the way to go. And a really good example of this is Macquarie Bank. So in 2015, the Macquarie Group announced that it was acquiring Asanda Dealer Finance from ANZ. But to do that, they needed to raise money very quickly. So what they did was they offered a placement of $400 million to institutional and professional investors who had the funds to give to them. And they also offered share purchase plans of $10,000 per shareholder. And they offered free transaction costs, free brokerage costs associated with it. So all they had to do was pay the $10,000. So this is a really good example of businesses that have used these methods. So we've looked at what public companies can do. So what about what private companies are able to do? They obviously don't have access to all these different options that public companies do, but they still have options in how they can gain funds. Firstly, I'd like to identify what a private company is. So just like a public company, they're incorporated, they have limited liability, they are not liable if the business goes bust. They can't come after the owner's personal assets. But with a private company, they can't advertise to the public for shareholders. So they can't list themselves on the stock exchange and get anyone in the general public to buy shares in them. It's select people, invitation only. Private companies have PTY Ltd after their name, so proprietary limited. Public companies only have the limited. And some well-known private companies that you may know of here in Australia is Linfox. You may have seen the trucks driving around mostly on highways and on main roads. They're a logistics company. We've got Meriton, which you will definitely see lots of these apartment buildings throughout Sydney in particular. And we also have the Cotton On Group, who owns Cotton On Body, Typo, Ruby Shoes. They are another group that is private. So in terms of private equity, the only option that private companies have is to invite specific people to become part owners. So they either have pre-existing relationships or they know them as an investor, but the private company has to go specifically to those people and invite them to buy shares into the business. They don't do it through the Australian Stock Exchange, and they don't involve invitations to the general public. So that is the end of our different external sources of finance. We'll be moving on to other influencers in future videos.